Hi, my name is Ravi Anupindi. I'm here with three people from Cisco. Mr. Kevin Harrington, he's Vice President of Global Operations at Cisco's Customer Value Chain Management organization. Then we have Lance Solomon, who is a Senior Manager with Cisco's Risk Management Group. And then finally, we have John O'Connor, who is the Director of Supply Chain Management and their Supply Chain Risk Management Program. We're going to discuss how Cisco does supply chain risk management. Kevin, perhaps you can start us off with how did Cisco start on this on its journey in supply chain risk management?
Yeah, great. Thanks for having us today, Ravi. You know, several years ago, Cisco was very concerned about risk management, but it was in a bit of a theoretical kind of context. And so what I was challenging the team to do is take that theory and move it into action. So it was really about building an integrated platform, making it possible for us to use analytics, ultimately so that we could have a decision-making kind of capability, and at the same time show up in an industry thought leadership sort of way.
The risk management engine has been around for some time now. I'm sure you've dealt with many incidents, disruptions, etc. during this time. Lance, perhaps you can tell us what you have learned from these experiences?
Each event brings its own intricacies, and what we do, the most direct way for us to learn from these events is to have a closed-loop process by which we take the learnings from the event and feed that into what we call our playbooks, which is how we prepare for a crisis and any range of disruptions that might happen to any one of our supply chain locations, and plan for that ahead of time.
So one of the things that happens is you plan for a certain event in terms of recovery, and that's the normal health of the system, the normal recovery, etc. But it is possible that as these events are unfolding and we are recovering from those events, maybe there's another event that occurs. John, how do you deal with these extreme situations?
So what we do at Cisco is we measure time to recover, TTR, and that's based on how long it takes for a supplier, a manufacturing partner, any supplier in our supply chain to recover from a catastrophic disaster. So we are assuming the worst case scenario. So by taking that very conservative approach, we think that we are measuring based on any disruption, the worst possible case. And so even if there was a follow-on disruption, that's something we think is factored in.
So all of this requires a lot of critical human resources to be trained in doing supply chain risk management. What is Cisco doing in terms of training people to be able to do these tasks efficiently?
So we have something called the crisis management team, and what we've done is we've identified all of the key roles in the event of a disruption. That's everybody from product operations, manufacturing operations, global supply management. We've identified the key roles. We've assigned responsibilities in the event of a crisis. And in some instances, our playbooks are actually scripted for a specific type of disruption, a hurricane or storm season hitting us that we know is going to happen year over year. In other instances, we have a more agnostic playbook, so we don't want to be too tailored to whether it's a fire or an earthquake. So we do both. We have specific trainings, we have broad trainings, and we have very, very clear roles and responsibilities defined in our playbooks.
Have you ever been caught off guard in terms of an event that is not in your playbook, John?
We have never been caught off guard. There are certainly nuances to the event. I mean, every event has its own set of intricacies, and there are unique things that happen. And so that's the reason why we don't overly script the response. That said, we've had a very successful response rate. We do find that the crisis playbooks that we've developed are applicable, they're broad, they're agnostic in most instances, and so we haven't been surprised yet.
So one of the key metrics you use is revenue at risk during the disruption. Are there other metrics that might be considered? For example, if your client is a hospital, revenue is the last thing that they would be worrying about, or for example, if your client is a defense establishment. So how are you thinking in terms of these metrics beyond revenues?
Yeah, one of the key ways we do that is we tend to think about what's critical for Cisco. And while revenue is obviously a vector that we try to prioritize on, we also look at things like, is it critical for us to be able to close our financials? Is it a critical metric that the organization is using to meet our commitments to our customers? So we think along the dimension of what is critical for the business, and obviously revenue is one of the bigger vectors that we focus on.
But from a client's perspective, this is revenue for Cisco. But post-disruption, if you're unable to service the client, revenue might not be the only metric that is appropriate.
So one of the ways we define critical is key metrics for the organization. Some of those include customer satisfaction. They also include in our customer operations centers, what's our response rate? How close are we to the customer? Obviously, if you're at a customer center, a matter of minutes can mean a lot more than minutes at a factory or even a supplier location. So yeah, we have to take all of those ranges of how we can define critical into consideration.
One of the key elements to your risk management is business continuity planning. A key challenge becomes for a company like yours that has an extended supply chain, how much of BCP do you do it yourself? How far back in the supply chain do you go? Do you go to tier 1, tier 2, or do you leave it, the BCP planning to your partners to reach out further down in the supply chain? How do you make that decision?
So for us, BCP, first of all, just quickly on vernacular, in some instances, people define BCP as their total program. BCP for us, business continuity planning, is very specifically focused on the assessment of our supply chain partners, component suppliers, manufacturing partners. What we've done at Cisco is we've identified the key partners for us, and that community grows, of course. We're at around 700 supply chain partners that we deliver a BCP to on a semi-annual basis. So what we're doing is a continuous program of assessing the supply chain, hitting them twice a year, working with our partners twice a year. We really do find that we keep the issue in the front of the discussion. We have a continuous stream of information coming in, and then we rely on those 700 partners also to assess their tier 2 supply chain. So we're leveraging that community to reach into the tier 2s. What we also do, though, is we may find, for example, that we have a number of fabless suppliers that are relying on the same foundry. And so in those instances, our analytics tell us that that is a significant tier 2 supplier, and because of that cross-reference, we'll reach directly into that relationship and we'll BCP them as well.
So which means that the data that the tier 1 is feeding you on their BCP, etc., you need to do some analytics on that data to even understand that there might be a common tier 2 or tier 3 supplier down the supply chain who's feeding the entire supply chain.
By having the BCP program go out every 6 months, about every 6 months, that continuous stream of information allows us to do that data mining, find out who are those key partners at that tier 2 level, sometimes even at a tier 3 level. And so by having those analytics, the opportunity to look into the supply chain, we know where we need to reach deeper. And we also know that we need to rely on our partners to make sure that they're doing the same level assessment for their tier 1s. So we're using the community directly, we're using the analytics from that community, and based on that, we think we're reaching as deep as we need to.
Great. This requires a lot of information exchange from your suppliers. You're asking your supplier to submit a lot of information that's fairly detailed at the facility level, at the plant level, etc. Do you ever face resistance from your supply base in terms of sharing such information?
We found in many instances where we're asking open-ended questions, we weren't able to tabulate that data, we weren't leveraging it, and so that was an opportunity for us to look and figure out, could we ask a fewer set of questions, could we ask them in a more objective manner, are you compliant with this standard, yes or no? If no, when will you be? And what we're finding is suppliers, the response rate's going up even further. So we want to ask better questions, we want to be objective wherever possible, and obviously the fact that we have a consistent instrument that we deliver every 2 quarters, every 6 months, that helps because, again, we have that cadence set up with our suppliers to respond.
After doing BCP, of course, you need to have risk mitigation strategies in place. So the kinds of strategies that you deploy, for example, dual sourcing, alternate site qualification, or even building inventory buffers. How do you reconcile this with the lean paradigm?
If you look at Cisco's operating policy, lean is the way we operate our business from a day-to-day perspective, but there are mechanisms or processes with which we can introduce additional inventory or even additional flexibility into our supply chains. And those explicit funding processes allow us to make those trade-offs between lean versus mitigating our risk versus potentially capitalizing on maybe a customer upside. So there's a governance structure in place to address all of those types of asks of the business.
I could just add, by the way, the 2 programs cannot be reconciled. I mean, one way to think about this is Having a resilient supply chain and having a lean supply chain in expected fashion are going to move you in different directions. Part of the conversation is understanding that and just having a grown-up discussion about having the need for inventory, for example, in certain instances where we find a component that has a very high ship-set revenue implication. We're putting that component in many, many products. And so if it's not available, obviously the revenue exposure is great, the customer satisfaction exposure is great. When we look at the ROP sizing, what we're doing from a lean perspective, that's where we need to look at those two competing agendas and just have an explicit discussion about, in this instance, we're going to give up some of that lean efficiency in the interest of having flexibility and resiliency in the supply chain.
Now you talk about giving up efficiency at some point to get resiliency. But consistent with the lean paradigm, how do you think in terms of continuous improvement framework around this? So for example, today you may have sized the buffer in a certain way, or your supplier reports a TTR of say 12 weeks. Well, there is something that you're doing to say, in a year or so, I expect your TTR to come down to say 10 weeks or 8 weeks, because that has implication. So that's kind of doing resiliency, but also taking continuous improvement paradigm. Is there something that you have done along these lines and put something in place?
Sure. Yeah, so the way we address that is we define explicit goals around time to recover, and we look at the entire supply chain, whether it's a contract manufacturer, a supplier, a logistics partner. We look at all of those nodes within those partners that are above our stated recovery objective, and we'll work throughout the program to develop mitigation strategies in cases where you may have maybe something that's unaffordable from an inventory perspective. We can partner with the supplier, work with them on strategies to understand what's their key limiter or long pole in the tent for TTR, and together partner on how we reduce that to meet our stated objectives.
Now, for some industries, people will say that resiliency is a luxury because resiliency has a cost and we cannot afford to do this stuff. As you know, certain industry sectors are under tremendous cost pressure these days. How do you respond to that? Is this really a luxury?
So certainly from Cisco's perspective, we think it's an imperative. We don't think that there's anything luxurious about it. There certainly have been numerous studies that indicate that in the event of a disruption, one of the things we know that happens is that there's an adverse impact to the stock price. And typically, that adverse impact does not recover in a very timely manner. Sometimes as much as 2 years plus out, you're still seeing a depressed stock price. So from a shareholder perspective, we think having resiliency is an imperative. The other argument would be that there is certainly a perishability in demand, and so we need to be able to respond to that. Customers will go elsewhere. So even in very lean industries, the argument would be that that short-term resiliency that you're providing for, and they really are shorter term in nature, obviously is going to pay off over time. The last thing that we would argue would be, Cisco is probably a bit uniquely positioned because we're a margin model. And so for us, it's imperative that we not forfeit any of that demand, that we not leave any sales unattended to. And so for us, it's an imperative.
Now, the risk mitigation strategies we've been talking about could be considered as more operational measures to mitigate risk. For example, having a buffer, having a second source, et cetera, et cetera. Now, the insurance industry, on the other hand, could provide tools to mitigate similar risks. How do you balance the mix between operational strategies to mitigate risk versus using a financial market, for example, to mitigate risk?
Well, I'll start this off, and Lance can go a bit deeper here. We've joined the programs. So for us, what we think about is when we have an operational risk, for example, that alternate site qualification that's going to bring our recovery time down, or having a multi-source relationship, which again allows us to recover quickly. What that will do is that will have an impact on the potential interruption to our revenue. And so when we think about business interruption insurance, for example, we may have created less of an exposure. And so in that instance, by having the operational and the financial hedges work together, we can reconcile them and ultimately make those two programs work in concert.
Yeah, I would just add to that. I think if you look at our short-term situation relative to business interruption insurance, we're in a capacity-constrained situation, which means we're not able to insure as much as we would like to relative to the values that are flowing through our supply chain locations. With that said, until we get to the point where we're explicitly trading off recovery time versus insurance, at this point, any benefit we see from recovery time actually just opens up more insurance for us or opens up additional capacity, as opposed to spending maybe extra dollars on premiums. I think in the future, now that we've got the programs tied together, we're set up to have those discussions when we get to that point with our risk improvement strategies.
Beyond operational and financial risk mitigation strategies to capture the impact of disruptions and how we address those issues, there could be other kinds of issues that are going on. So, for example, a labor unrest, strikes, or even changes in labor policies in a particular country that typically companies have to deal with, and they probably have dealt with from a social responsibility perspective. How do you integrate that into your risk management framework?
Yeah, absolutely. Well, it's obviously related, and it has to do with the robustness of our environmental scan. So the data set that we want to work with is obviously the BCP data set, but also the perspective of our environment, which is constantly changing. So all of the things that you talked about, civil unrest, availability of labor, these are all things that we're monitoring regularly, and they're actually adjacent to our sustainability and corporate social responsibility platform. So there's an ongoing dialogue between those two groups inside of, in our case, our Global Business Operations Organization.
Great. All of these seem to sit within the SCRM part of the organization. How do you move this discussion of risk to the next level? So, for example, the C-level suite, the senior level executives within the organization, are they really sensitive to these issues? Do they appreciate the effort that's going on? Or how do you actually communicate the value of doing risk management to the C-level suite?
We opened the segment talking about having a decision-making platform that was a competitive advantage. And the investments that we've made, the capabilities that we've created, and the quality of the team that we've, as you can see, I mean, these guys do this for a living and are really terrific. That allows us to have a completely different conversation in the boardroom. So whether we're talking about financial risk assessment of our supply base and offering an expert opinion about that, or we could be talking about new ways of measuring ourselves and holding ourselves accountable, a la the resilience index. These are all ways for us to prove to the corporation that we actually have a perspective that is compelling, and most importantly, we can show up in that critical moment of truth with the piece of information that the board is most interested in.
So are there specific metrics that you're using, say, for example, at the business unit level to measure resiliency?
The resilience index, which is obviously a weighted average, is something that we've instantiated inside of our development organization as an additional metric that each vice president, general manager has to be accountable for. And we review that at the John Chambers level.
So obviously there's a lot of effort and resources that have gone in within Cisco to be able to do risk management. How would you advise smaller or medium-sized companies to think about risk management? Because they may not have the resources that Cisco has perhaps. How should they go about thinking about risk management?
We are fortunate at Cisco that we've been able to invest in a discrete program, and we're probably a bit unique, although we're seeing more and more of that. That said, I would say there is an opportunity for all of us to figure out how do we prioritize the risks we want to manage. At Cisco, we've elected to focus on the top 100 revenue products. In so doing, those top 100 revenue products, it's 103, represent 50% of our overall revenue. If we look after those, we'll be focusing on not only our customers, but our shareholders as well. And obviously, by focusing on those top 100, there'll be a cross-reference to the products that are farther down the revenue stream. So for us, it was deciding to focus on that specific subsection of risk. I think any company has that opportunity to figure out, what are the most important risks, decide what they're going to focus on, and then the one thing that we would advise is stick with it. There is always a temptation in risk to switch horses. Today we're focusing on product. Should we be focusing on region? Should we be focusing on some other attribute? And what we would advise is, big or small, pick the segment of risk you want to focus on and stick with it, because that's how you're going to make progress. Last thing we advise is you have to have a BCP program. We speak with a lot of companies who think they know what the risks are. They're going to go out and they're going to try and attack them, but they're not doing it with data. And so for any company, having a BCP program, and by the way, their suppliers are being asked for that data by all their other customers, and so the information is available. Having an informed BCP program will let you figure out where your real risks lie, and then deciding on that segmentation and sticking with it until you've really conquered those risks.
So you talk about your suppliers being asked by other customers about BCP, etc. That raises this whole question about, while Cisco is doing this across the global supply chain, what actions can be taken to move the discussion around risk at an industry level. Cisco, you are one of the best in class in doing risk management. What are you doing to push that standard perhaps, or to propagate this across the industry, other industry sectors?
It's one thing to be operationally excellent. It's far more interesting if you can be, if you can lead an industry in operational excellence. And one of the ways to do that is by getting an industry agreement around a standard. So in our case, we convened the Supply Chain Risk Leader Council, which you participate in, representing University of Michigan. And along with other major industry flagship companies, what we've been doing is writing that resilience standard, the 28002 resiliency in the supply chain standard. And that's a way for us to all have a common denominator for what resiliency means, what supply chain risk management means, and most importantly, it's a way for us to give something back to the industry via thought leadership and collaboration.
On that note, gentlemen, thank you so much for being here at the Ross School of Business and sharing your thoughts on supply chain risk management. Thank you so much.